Within the ETF space, there's been an explosion this year in both income-generating strategies as well as active management. Perhaps not so surprising, as one layer may necessitate the other. So we've looked at fixed income, options overlays, and the like, but now we want to look at another layer. That's preferred stocks. Joining us now is Jay Hatfield, founder and CIO at InfraCap, and Todd Rosenbluth, head of research at TMX Vetify. So, Jay, I want to start with you here because you run the Virtus InfraCap U.S. Preferred Stock ETF. It's up almost 20% for the year, leading its competitors. How does it work, and what kind of companies are in it?
Thanks, Pippa. It's great to be on. Well, it is important, as you alluded to, with fixed income to have active management. So what we do with PFFA is, instead of cap weighting, which is what the big index fund does, PFF, so we do ticker arbitrage. So we're PFFA, so it's active version, in effect, of PFF. So we select companies that we, by our own ratings, are mispriced relative to their risk and the yield. And then we also manage call risk. So if the securities trade above par, we sell those. We run modest leverage. We normally run 20 to 25% leverage. And so that's worked out well. We've had superior income and also superior total return.
All right, so that's the strategy at the highest level. What are the top holdings in the fund itself?
Most of the top holdings are in what we call asset-intensive businesses. So companies like a lot of viewers probably know Energy Transfer is a gigantic pipeline company. The rating agencies don't like pipeline companies because they pay dividends. And so we like those asset-intensive businesses. And in the case of Energy Transfer, the company as a whole is rated investment grade, but the rating agencies also don't like preferreds. They give them three notches, it's called, with ratings. So the preferred's rated BB, which is non-investment grade, but the bonds are investment grade. So we like that situation where you get substantial yield, but really de minimis, or not de minimis, but small default risk.
All right, so Todd, I want to bring you in here because Jay's PFFA has seen about $500 million in inflows this year. How does that compare to other preferred stock funds?
Well, most of the preferred assets are in index-based products. So we've seen products from iShares, from State Street. There are some of the other larger asset managers that offer preferred ETFs. But I would broaden this out a little bit. We are seeing growing demand for active fixed income ETFs. They've been punching above their weight in 2024. We've seen firms like Capital Group and T. Rowe Price, Fidelity have a lot of success. BlackRock brought one of its best known PMs into the active ETF world about a year ago and has had a lot of success with the BlackRock Flexible Income ETF. So we are seeing some of the larger asset managers focus on active income strategies and have a lot of success.
All right, so Jay, broadening things out here, you have a 6,000 forecast on the S&P, noting the risk to your target is mostly to the upside. So how much of that price target hinges on the Fed's rate cut path from here?
Well, it's obviously critical. I mean, that's really one reason that fixed income, particularly higher risk fixed income, so high yield bonds and preferred stocks, they tend to do better than other fixed income categories when the stock market is strong and when we're coming out of a tightening cycle like we are now. So it really is critical, although we don't think there's a lot of risk to the Fed's rate path, because if you really adjust the PCE and CPI data for shelter, which the Fed is starting to do, thank God, finally, so you really get inflation levels that are below 2. So there's really no reason for them not to cut. And the rest of the world's cutting, and the rest of the world needs to cut because they actually are nearly in a recession. So we don't think there's a lot of risk to that, but clearly if they stop cutting, that wouldn't be, preferred to be okay, but they wouldn't continue to rally like they have been.
All right, so looking at the rest of the world as well. And Todd, we just saw the industry pass the $10 trillion milestone and many billions of inflows of that going into other actively managed funds like Jay's, as you noted. But you point out that active ETFs have gathered approximately 30% share of the industry's flows. But stats show that supply at this point is now exceeding demand. And given the ETF industry has a history of being a little overzealous, maybe, when it comes to trends, is it different here?
Well, I think there's notable demand. As you talked about, 30% of the overall flows have gone into actively managed ETFs. We've seen product development on the active side this year through covered call strategies, some of those options overlay, active fixed income, active equity strategies. This is what advisors and investors are increasingly turning to. And it's very hard for an asset manager to bring to market a product that's going to compete with the Vanguard 500 ETF, VOO, that charges 3 basis points and has gathered about $80 billion of net new money this year. So asset managers are bringing products to market that we believe investors want, and it comes down to education. And we've seen a number of success stories in the past year. So the T. Rowe Price Capital Appreciation Equity ETF, TCAF, is one of those success stories that we've seen that the fund has come out and gathered notable assets in the past year, and T. Rowe Price obviously leveraging its expertise in the active management space.
And sticking with that, Todd, ETF AUM typically takes about 5 years to double, but this time it was less than 4 years. Do you see that pace continuing, and do you think that they'll continue to take share from mutual funds?
Oh, without a doubt, active ETFs and ETFs in general are going to continue to take share from mutual funds. This pendulum is not swinging back. We're seeing investor demand for ETFs, whether that's institutions that are getting more comfortable using ETFs, and products that are tied to the CLO marketplace are a great example. We've seen Bitcoin products have success in 2024. That's a different investor base that has now moved into ETFs. Retail investors are gravitating and becoming more comfortable in using ETFs. ETFs are here to stay, and we're seeing more and more traditional asset managers file and launch products because this is where the investor base happens to be.